Good morning, everyone. Right, it's really nice to see everybody here, right, on a Saturday morning. I'd like to thank Edge for inviting me back to present once again, right, and for bringing me back to the CBD on a Saturday morning. Yeah. So today's topic is on enhancing property yield. Right, it's geared more towards retail investors, really not towards the institutional ones, because I think, and for many of us, I think our first investment is really on the residential market. Right, so it'll be a bit different from the rest of the speakers. I think I will focus a little bit more on the residential market, and go through some of the strategies. I would say that that can help enhance your property yield or your rents, right, when you rent a residential market. Yeah. So first one, I think the most important, right, is to be able to capture the meat of the market cycle, right. And this is a chart that shows, the rental indices, right, across the various property segments. Okay, the formatting is a bit off, but the blue is the private residential market, gray, the line below is office, green industrial, red is retail, right. And you can see, right, so the best performing asset class last year, right, the last few years, last 2-3 years, was the residential market, right? As you can see from the blue line, right? Rents have gone up by about 30% in 2022, right? So if you're a landlord, right, I think the last few years, it's been a very happy moment, right? If you're a tenant, then I think it's not so happy, right? Yeah, and what drove this, right? And I think, and the questions we have asked is, will the same trends, bring it forward, and what's the outlook? Right. So, right, I would say, the last year, I think the last few years, this is an outlier, right? 30% growth in rents is really not what you see regularly. I think the last time we saw this, where rents rose by 40% on 1 year, was in 2007. So about more than 15 years ago. And what drove this, right? It was a combination of very limited supply, right, because of the pandemic, construction delays. Right, so supply in the market, even going into before the pandemic, right, in the 2018, 2019, new supply for residential was really less than 10,000 per year, right? The long-term average is about 13,000 units, right? So when the pandemic hit, right, this was made worse, right? And very limited supply also drove, and also because new units were delayed, right, drove new demand into the market, right? Local demand, right? Some of them, families waiting to move into a new house, when their new homes were delayed, they moved into the rental market. So that increased demand. Foreign demand, because Singapore reopened faster than the region, right? I think Singapore reopened really last year, right, whereas parts of the region were still reopening. So that drove more foreign demand into the market. And that combination of higher demand and limited supply drove rents much higher. And going forward, right, will this change, right? What we know is that new supply coming into the market this year will be about 19,000. So it's higher than usual. It's also higher because of all the delays, right, that push what was supposed to be completed in 2022 was pushed into 2023. So we're seeing a lot of demand, a lot of supply coming this year. But so this will definitely temper rental growth, right? But the thing is, once this year goes, right, supply comes down again. So what does it mean, right? So as a landlord, right, I would say that there are downside risks, right, with new supply coming in, right. Tenants are also being more, I would say, resistant to current rents, right. For landlord, you want to capture maximum rental revenue, right. You could consider, probably not be too aggressive on rents. And also perhaps try to lock in a longer lease term. And if your tenant is on a 1-year lease renewal, right, move it to 2 years, right? That could help you capture the meat of the market cycle, right? And for the office and industrial, right, you can see so office is really tied to economic cycles, right? The Singapore economy is slowing down, but it's still moving along, and that for office, that has driven up office rents. I would say for office, right, we are seeing right now is a flight to quality, right? So it's really the newer office, right, that are being well sought after, whereas the older office, we are seeing slower rental growth. Right, so that's something to consider. So if you are strata office owner, right, if you are in, say, grade A, you own a strata office in a grade A building, then I won't be that worried. But if it's in an older build, right, and and you see higher vacancies, right, then I would be a bit more flexible on the asking rents. Right, so the flight to quality is something to consider. But rents are also influenced by mega trends, and you can see this very clearly from the differing trends from the industrial and the retail sector. Right, you can see before the pandemic, right, the rents were roughly the green and the red lines. They're roughly on the same trend. But post-pandemic, you can really see a divergence in rental trends where, because of e-commerce, right, and people are now shopping more online, right, you can see retail rents have come down quite a fair bit after, in the new normal. Whereas for industrial, it has been on an upward trend, also driven partly due to limited supply, right. So for retail, I would say it has been on a downward trend for multiple years, right. I think it's reaching a bottoming out stage as well, right. What you're seeing, because of the pressure from e-commerce, there's been quite few new retail supply coming into the market already, right, as compared to last time, right. So I would say, going forward, we should see an increase in retail rents, right, coming from a very low base, though I would expect the increase to be quite marginal, to be gradual. Yeah. Next. So aside from capturing, raising your rental revenue, right, I think pricing also matters, right. This is a chart on the price trends for the various sectors, right. Because the lower below market price you manage to get, right, the higher probability you're able to get a good property yield, right. So pricing matters, and where you come in the market cycle is important. For this chart, I thought it was noteworthy to break up the residential market into the three segments, right. The top two lines, right, the grey and the red, these are the mass market and the mid-tier, or as the outside central region or the rest of the central region, right. These are more on the city fringe suburban markets. And the blue lines, these are for the high-end market, the CCR. And you can see, unlike how rentals moved, right, where rents, I think across all three sectors, they move fairly in tandem, right. I think all three sectors all grew by at least 25% in 2022. For the high-end market, right, it has really been a real underperformer as compared to the suburban and the city fringe markets. And why? And this is also because this is due to Singapore housing policies, right? You have all the cooling measures, which what it has done is that it has hit demand, foreigner demand, right? I think ABSD has now been increased to 60%, right? In the past, it was 30%. Right? So foreigners, they are really a bit hesitant to invest. Right now, it's 60%, it'll be even worse, right? And the CCR has more demand from foreigners compared to the rest of the regions. I would say it's not the majority of demand. I think it takes out about 10 to 15% foreigner demand, but it's still significant as compared to the mass market and city fringe, which is about 5% or less, right? So you can see, right, there's been a real difference in growth, and going forward, what would be the outlook, especially for the residential market? This is a question that everyone asks, right? Will prices fall, right, in the next few quarters? To me, chances are not really. I don't think so, for a few reasons, right? Number one, right, the jobs market is still, while it's slowing down, it's still really healthy. Unemployment, I think in Singapore is less than 2%, right? It's really, really low. And to me, as long as you have a job, right, you always pay a mortgage, no matter how much interest rates go up, right? Which is also starting to slow down. The increase in interest rates, right? So people will continue to hold, right? And it's not so easy to trade in the market nowadays as well, right? You have your buyer's stamp duty, which has gone up, ABSD has gone up, and people still like to invest in Singapore property, right? So if there's that propensity to trade in the market is really much lower right now, and people will tend to hold as long as they are able to finance it, which most are. I mean, given current loan curves, right? The leverage in the market is really not as high as what you will see 10, 20 years ago, right? But what's interesting is for the high-end market, because of cooling measures and because of what's I'll say the factors that impacted the underperformance, right? It could actually be an opportunity, right, going forward. Because I mean, people ask, at this rate, will your city fringe prices go higher than your high-end market? Right? High-end market right now, I think new launch is about 3,000 per square foot, right? City fringe is really about 2005, 2006. Right? Will it ever exceed high-end? I don't think so, because I mean, I think property is still about location, 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 right? So with this underperformance, I would say there could be some opportunities, especially for in the resale market, where we are seeing some units go for actually below 2,000 per square foot, right? And so going into the other sectors, right? For industrial, office, and retail, right? You can see it's really particularly for the industrial and the retail, right? There's really a divergence in trend, right? I would say the pandemic has really helped the industrial sector, right? You can see prices are still going up, right? Amidst limited supply. For retail as well, I mean, similar to the rental trend, it has come down in tandem, but I would say it's probably reaching or approaching the end of the cycle, the bottoming. Because it's like the lower you go, I mean, the higher chance for it to bounce up eventually, right? And for office market, right, it's not as good as industrial. I think it's also because of the flight to quality, where the good quality assets, like for example, there was a new strata office, Solitaire Cecil, right? It has been sold out already and sold for really very high prices, right? But for the older strata offices, these prices have not grown as much. Yeah. So this is a chart. I mean, this is something that we to categorize the different investment strategies, right? But I would say for most part, right, if you own a strata unit or a residential, mostly you will buy for core plus, right? Sometimes you will do a value add strategy. So I mean, just to make it a bit simpler, the new HDB thing, right? There's the prime HDB, HDB plus standard. Yeah. So core is like prime, core plus is plus. Basically, core is a central location near MRT. Everybody wants to stay there and rent, right? Core plus is more mass market, suburban, and but so location further wide, but near MRT. So that's plus, right? And value add and to redevelopment, this just shows the different capital expenditure you have to put in, right, to increase the value and the rental of your property, right? So if you have a condo, right, likely when you buy, it will really be for the recurring income. And I would say there's limited strategies that you can do to raise the income, to raise the rental. So knowing the market cycles, right, and getting in is particularly important, right? If you are a residential landlord, so not the strata one, but you own the land, right, you have more options. You can choose, value add, redevelopment. So like for landed market also, right, the specs do matter, right? You read the news, right? People are renting out for like 100,000, 80,000, right? These are usually very well furnished, landed properties. If yours is not furnished, right, the rents are really usually below 10,000, right? Similarly for shop house, depending on the location of the shop house and whether it is a conservation shop house or not, right? You have more options. If it's a conservation shop house, you can't change the facade, right? And you can only change what's internal. But there are some shop houses that allow you for rear extension, right? So for those kind of shop houses, you can actually choose to pump in capex, to increase the net leasable area, right, by building up a rear extension. And finally, maybe just to wrap it up, this is my final slide, right? And so it's really to increase property yield, right? I would say there are three key things to do, which is one, lease management, right? Which is really in a good market, right, when rents are going up, right, you can be more aggressive, right, and increase rents, right. This, I would say, makes the bulk of how you increase your property yield. But of course, if you sense, that we are reaching the top of the cycle, right, then it may be better to lock in your current rents, right, and also to be a bit more flexible with your tenant, right, because you don't want to be hit with higher vacancy costs, right. 1 month of vacancy equates to, for a 2-year lease, is about 4% of your rental revenue, right. So you need to get into a good balance, right. For residential, you can consider room rental. That's one way to increase your revenue. But I would say you really need to know your tenant market, right? Room rental usually caters to the student student tenants, and usually these are for properties that are near to those tertiary educations, like those like NUS, right? For example, NTU, where there's a lot of students that are looking to rent, right? And it's usually synced to their school term cycle, right? So you must, not every property can be used for room rental, right? So you must be know what's your tenant pool, right? And similarly for commercial and industrial, right? I think the same thing, right? Mostly it's mark to market, and also manage your tenants. If the tenant is good, then it's probably wise to keep them and to just manage your vacancy costs. For asset enhancement, for residential, from what I hear, right, for rental units, usually most of the time you don't want to spend too much money to do out the apartment, means not to do too many fittings, because typically every tenant may have different preferences, and some of these tenants may also bring in their own furniture. So you don't want to spend too much money and in the end, have to move it out if your tenant really wants to bring in those own furniture. So typically, what you want to do is just do maybe painting, more like painting works, make it presentable, right? And if there's anything that they want to add, then this can be added into the rents. You can choose to spend it, and you just amortize it via the rents. Redevelopment will be more for the landed units, right? For shop houses, right, as mentioned, you could consider increasing, for some, if the shop house is eligible, right, increasing the NLA through development, right? But it really depends from shop house unit to shop house unit. You have to check whether, what options you have, right? Change of use, if you're able to get change of use to F&B, to get approval for F&B, then this will help you increase the income. Because F&B units tend to be able to attract better rents, like more than $10 to $15 per square foot, as compared to non-F&B, which is usually about less than 10, right, depending on location, right? But of course, you have to ensure that you have the F&B specs, right, like it's able to provide for kitchen provisions and power supply. And finally, the last one is to lower your expenses. And to me, the key thing is, think about how to lower interest rates. So it's really, about being aware of your refinancing cycle. When it's time to refinance, right, go and speak to the bank. Ask them, go and compare. You can get a mortgage broker, right? I find them, they're quite useful. They always tell me, these are all the rates in the market. And typically, what I notice is, if you get a lower rate from another bank, right, you can usually call your bank and ask, this bank so they're offering me this rate. Can you please match that? Can you be more competitive? And so far, it has worked for me the last 2 times. Yeah, so that is something you can consider. Yeah. So with that, I would like to wrap up my presentation. Yeah, thank you.
Morning, everyone. As you can see, thanks for joining us on a Saturday. Well, as you can see, the topic that the presenters present goes with the flavor of the market. Clearly, I think REITs is probably now not the flavor of the market, and that's why you have presenters that are talking about a residential. So, that is a signal of a market to come. And why is REITs then not so much in the flavor of the month right now? Obviously, because it's costs, interest costs. I think over the last many years, or whenever we as REIT managers, we see investors, whether institutional, retail, or anyone, the focus is always on revenue, top line. How can you increase your DPU? How can you increase your top line? And all. And not much attention was focused on costs. I think the last 12 months with global inflation resulting rising interest rates, it has become a big topic. And the last 12 months has also shown that not many macro events which affect costs actually may have an impact, bigger impact than you trying to do all the strategies to raise revenue, because it's fundamentally, it's structurally inside. When we come to revenue, most of the revenues are coming from leases. But leases has a fixed tenor, 2 to 3 years or so. So how much of your rental reversions in a way depend on how much of your leases are expiring. I mean, if you have rentals that's going like 10-20%, but you don't have any leases expiring that year, unfortunately you can't capture that. So, but on the other hand, interest costs and expenses can totally flip us on the other side and immediately go down to your bottom line. I think the first example of that was coming, that made everybody sit up for costs, was utilities back in late 2021, early 2022. And it started because of the Ukraine and Russia war, where utilities spiked up hugely, and a lot of REITs, everyone in the whole market, from retail, industrial even, and office, all got a hit with that. And it was shown in the numbers. That was a signal for a lot of us REIT managers to sit up and say, hey, you know, something that we have not been looking at, put it in the rear view mirror, actually could wipe out a lot of expenses, a lot of revenue, and go straight into the bottom line. So people start to look at it. At the same time, we started to see interest rate rises. So it's come to a point whereby right now the focus is actually on people talk as a whole and managing costs. And today I will try to share with you how some of these main factors of cost can actually go down to the bottom line, what we should be, not just us, but actually a lot of the industry players are actually looking at. I think the first one is obviously the biggest elephant in the room, which is actually rising interest costs. You know, the market has probably in the last 12 months, we have probably 6 to 7 hikes, the US interest rate hikes from a low of 1% to now today 5.5%. And we thought that in 3 months ago, there was some respite to that when commentators started to see that, you know, interest rate may be peaking, but recently has come back up again, you know, and basically if you read some of the Fed minutes in front of the governors who talk, they're telling you, oh, everything is data dependent. Basically, they're telling you that they're not making the decision. They just wait for the data, and then they let the data tell you what to do. So essentially, that's what they're telling us, like, as good as not telling you anything that what they're going to do. All right, so, yeah, but we can't sit down here and then wait for the data dependent and then decide what to do with the things. So we think that that we further interest rate hikes, because if you look at some of the data, which is very mixed, but it trends to point still towards strength, whether retail sales or unemployment, jobs claims, still the data is still pretty strong. Inflation is still pretty high. Now, rising interest rate obviously has the biggest impact on 3 things. DPU, because once you refi, and I think the recent first half results of most REITs, I think all REITs showed that interest rate has gone up, and a lot of them has gotten hit at the bottom line. So rising interest rates impact our DPU. It also impacts NAV, net asset value, or valuation. Because higher interest rates essentially means that your discount rates and capitalization rates for valuing assets will have to go up. And higher discount rates means lower valuation. Lower valuation, it means that lower NAV. And the third factor of rising interest rate is gearing. Because if a valuation comes down, and that you do not repay back your loan, and loan remains the same, then your leverage will go up. And if interest rates stays higher than longer, then essentially we're back into a permanent cycle. Even structurally, we have changed. So rising interest rates affects actually 3 factors. Whereas, if you ask me, in a way, revenue only affect number 1 and number 2, DPU and NAV. But rising revenues impact on valuation takes time, because as I said, we have lock-in leases, so you cannot immediately have the full impact of the valuation. It takes time through the lease cycle. So the question becomes, how do we manage interest costs? The question now in the market is not when will interest rate peak, but how long it will stay there. How long it will stay there elevated, and that has implication on a lot of strategies of us as REIT managers as well. Not just immediately managing the interest costs, but also looking at the kind of return requirements that we require from buying and selling of our assets going forward. But the immediate term is that you want to manage your debt expiries. You've got to make sure that your debt expiries are well spread out. The good thing about the yield curve, which is where interest cost is being priced off, is that the longer ends, the yield curve is now inverted. That means it's more expensive to borrow short term than to borrow long term. So that gives us an opportunity to say, hey, maybe it's better for us, instead of borrowing 3 years and 4 years, to maybe now borrow 5 years or 6 years, so that you spread out the debt expiry profile. And if the interest cost stays higher for next 2 to 3 years, then at least you don't get hit too big amount is expiry. Now at the same time, another factor that comes to us, another tool that we could look at is hedging. You could probably hedge at a longer term, but the shorter end, the next immediate 1 to 2 years, you hedge less in hope that interest rates will start to come down. Don't ask me when will interest rate come down. I don't, so maybe you can ask Krishna later. But yeah, I pass the buck to him. But the answer is that we don't really know when will interest rate stays. But from my personal view, and if I listen to what the Fed say is data dependent, I think we are going to stay here for some time, at least I would say 12 to 24 months of high interest rate environment. Why? Because if you look at Fed statement that they're data dependent, and you look at the data of where the target is, they want to go to a 2% target inflation rate. Inflation rate is, in US is still 4% and 5%. I think it will take quite some time before the 2% will come down, come down to 2%. So it means that the interest rate will probably have to be higher. And if there's anything, sometimes there was a REITs conference earlier this week where all the REIT managers were there, and there was some consensus. There was some of us who think that maybe sometimes it's quite good to just get one recession one time and then reset everything, rather than drag on for too long. But that is just our view. The second part, of course, is obviously inflationary pressures of property expenses. Supply chain continue to get disrupted. Labor markets continue to be tight. All the data points that you see, whether in Singapore or in US or around the world, points to the same. Now, energy prices has again become a concern. Even rise global temperatures. They continue Ukraine and Russia conflicts, and inflation pressures actually has a direct impact on our maintenance and utilities costs. Especially maintenance costs is a direct correlation with labor costs as well. Mr. Yang mentioned, right, labor is still tight in Singapore, employment 2%, so the cost is there. What we would do is that from property expenses generally, the two big items are actually utilities costs and maintenance. What we try to do is that we convert by how to manage utilities costs is that we convert some of the contracts with tenants on a pass-through basis. So it used to be that we landlords tend to make a fair bit of money. All right, so we buy from SP Power at wholesale prices. We break up, and then we basically are like a coffee shop owner, okay? Okay, buy from SP, and then after that we sell the utilities to that. And we did get a good spread. Don't get us wrong, we did get a good spread. But I think the problem we have is that we buy from SP at a long-term we tend to have a shorter tenor. So when MSP is not going to sign up with you for 5 years and lock in at the low rate, because they also have to manage their stuff. Whereas with tenants, we tend to be lock in the income on the longer term. So when utilities shift, cost shift, we are going to mismanage. So going forward right now, since the Ukraine crisis in late 2021, early 2022, a lot of us, at least for our REIT, we have put through on a pass-through basis. That means whatever we buy from SP or other utility provider, we just charge the same as the tenant. So we don't earn any spread. I think the answer is that we, as landlords, our focus is on leasing out space, doing asset enhancements, redevelopment, rather than trying to bet on the direction of energy costs. We are not readers of oil prices. At the same time, obviously, even if you can pass through, there's always common areas, especially for us where there are multi-tenanted assets. We try to harvest solar energy to reduce utilities costs for common areas. But this is not something that's big, so we're not too worried about inflation, utilities, rising utility costs on common areas. In terms of managing maintenance contracts, we try to amalgamate contracts together. But we have 20 contracts. If we have 80 properties and we have 80 contracts, we don't amalgamate all 80 and then give to one, because it increases the risk of concentration risk. What we do is we amalgamate probably and spread into packets of groups of 30, 40 in one batch, second batch, and do the different suppliers and do expiry, so that in the times if interest rates spike, you don't have all 80 properties maintenance costs going up. And we also try to work with a pool of trusted service providers. We have a so-called a panel of service providers that we always work with. So we know that even though we cut their costs, or if we amalgamate, they give us a good price, the service quality is not compromised. So that's what we try to do. And also, in a way, we also review our service charges. Rentals comprises of two components, what we call a net rent that is for the space that you use, and also a service charges for all the property tax, utilities, and also sometimes we do have a chance to review utilities. We don't always try to review utilities. I mean, can you imagine HDB every quarter tell you I'm going to review my conservancy fees? I think you don't be very happy as well. So the same as our tenants as well. So, but if the expenses is really getting out of hand, we have the opportunity in our contracts and our lease terms with tenants to review service charges. Now, another one that people tend not to look at is, which is actually in my view, is a cost, is the strength of the Singapore dollar. Since the start of the year 2023, Sing dollar has strengthened against major currencies: Australian dollar, yuan, Japanese yen, a lot of major currencies. Ringgit, I mean, ringgit is probably the one that you all know the most. Now, what does this impact? Rises in and the strength of the Sing dollar is, well, we have seen this movie times and again. Whenever the world is in a mess, Singapore is a safe haven, and then that's where Sing dollar actually strengthened. And it's not helped by the fact that Singapore, how we manage imported inflation is through the Singapore dollar. So the strength of the Singapore dollar is there, and it is an cost. It's a cost item to us, is in a way, because that a strong Sing dollar has a negative impact again on the three things: DPU, NAV, and gearing. And this is probably a second punch to rising interest costs.
Because a strong Sing dollar, because you collect, especially assets, REITs like us who have overseas portfolio, 25% of our portfolio are overseas. I mean, we still have 75% based in Singapore, so that's good. We are shielded from that, but 25% is still based overseas. A strong Sing dollar means that your Sing dollar rental income will be lower. And also affects valuation, is because when you translate back to Sing dollar, in Sing dollar terms, the valuation is lower. And the valuation lower could potentially means that gearing is also higher. So that's why I say that the Sing dollar strength is a second punch to rising interest rates, which earlier I mentioned how it impacts the three things. So how do we look at it? We try to mention the majority of Singapore portfolio first. As far as possible, when we want to fund, we don't do a carry trade, we fund locally. So if I have a Japanese property, I borrow from the Japanese yen. rather than to borrow from Singapore dollars and then borrow in Sing dollars to buy. Because if you do that, you have a big problem when the yen depreciates. Whereas if you borrow locally, if the yen depreciates, at least in Sing dollar terms, your interest cost in Sing dollar will also be lower when you translate back. And we also focus on developed markets where currency fluctuations are less volatile. I think developed countries are the ones that are seeing a little bit more fluctuations in terms of the strength, and the increase in the strength of the Sing dollar is actually more pronounced against these developing countries like your Indonesia rupiah, Malaysian ringgit, Vietnam dong, and all. So, I mean, the quick one, the last one is that I just take a quick slide. I think outlook-wise, Krishna is probably the best to tell. But I think from our manager's point of view, that we expect the second half global growth is expected to moderate. All the various bulks of the interest rate increases are taking effect. How effective it is, I don't know, but it is definitely taking effect. China's reopening is a letdown. Pretty clear. The global demand from the opening did not materialize. In fact, it has probably slowed down even as compared to it was closed when China was not reopened. And the biggest risk right now is a stress in the China's property market. One guy has gone bankruptcy, which is China Evergrande, Hengda. Now we're talking about Country Garden is the one that's making the news right now. And the problem we have is that if these two guys are in trouble, what about the many other smaller or mid-tier property companies in China would be? And that is where we're afraid that there will be a contingent effect globally on availability of funds. And as you know, in REITs, access to funds, especially the debt and loan market, is very important because we don't retain cash, we pay out everything, you know. So that is something that we are watching. The question is whether the China property market will be a Lehman moment like in 2008 that results in such a big contingent effect that availability of credit dries up. And also, look, I think Singapore is doing well, but it's clearly that we are slowing down. Manufacturing demand is weak. The NODX that was just just released has dropped 20% year on year, and it's on top of the 15.5% drop in June 23. So the weakening trade outlook and manufacturing demand is expected. For industrial sector as a whole, we are seeing slowing down of, you can expect rentals to slow down. Do we expect tenants or industrialists to go belly up? No, I don't think at this moment I can say that we are. At least from our REITs, we are still seeing rental collection. Rental collections are still strong. I always tell most investors is if you want to see whether your tenants are doing well or not doing well, the first leading indicator is every month is he paying your rentals on time. If he start to, what you call in local terms, 抄小, then you know that, okay, this guy has some cash flow problem. You better watch it. You better start to talk early. Rather than 3 months later, he come and tell you guys, I'm packing up, I can't. So right now, our rental collections is still decently okay. What we are seeing is that for new spaces, the time taken to fill up the space is taking longer. As Jian Yang mentioned, there's also tenants, those that can take up new space have flight to quality, looking at better spaces for the same dollar. So occupancy will probably stay or drop a little bit thereabout because of these new spaces. But I think rental reversion, I think depends. I think the industrial market, especially logistics, is still strong. So you'll probably still see high-digit rental reversions, but you probably won't see double-digit like per last year. So I think overall, second half, my view is that will be volatile. Be prepared that rising interest costs will continue to eat into bottom line. There will be impacts on valuation and NAV. Inflation fears will continue to linger, especially Fed wants to be data dependent. I don't know what kind of data they're looking at, but everything looks mixed, right? So how do you make a decision? So that is going to be, means that there's uncertainties. You know, China's faltering economy recovery and property market is something that we need to watch. My sense of it is that in the next 6 months, the financial market, whether the bond or the equity market, will be rudderless. It will be trading very directionless. So you can expect opportunity volatilities, and for investors like yourself, you know, probably it's an opportunity for you to go in and all. But I'm not a stock picker. I'm not a stock recommender. So, but I think for us as a REITs, we generally believe strategy-wise 2 things. Number one, we've got to manage the short-term cost of what we just mentioned in terms of the cost. At the same time, a lot of us are reviewing the required returns. You know, we all REITs have IRR, DPU targets, and all this stuff. You know, what we call a return requirements as well as criteria. Some of these criteria will have to change because we think that if the interest rate is going to stay longer than expected, it will become the new norm. Then your return requirements will actually have to relook at it. So with that, thanks.
So thank you for making it on a weekend. Probably that shows, you know, the interest in the property sector, which I think is the second nature now, irrespective of whatever the interest rate environment is. And thank you very much to the Edge for giving the opportunity. So what I've done is stitched together, 6, 7 slides, and much of the ground has already been covered. There is already a lot of research in, you know, how REITs perform in a high interest rate environment, and I have clicked it from there as well. So feel free to go to the net and do your own work as well. And finally, to be honest, I'm still learning, so any mistakes, you know, pardon my mistakes here. So on that note, let's get started. So this is a main summary slide. You know, interest rates typically impact all financial instruments. But for REITs, it is a bit more for a few reasons. First of all, you know, REITs, as you know, is you're holding a property and you're financing a property through loans or bonds. Their cost goes up, so you know your net income that you get from those properties come down. Everything else staying the same. So that's one side of the impact. The other is the discount rate. So you know, you discount those cash flow the rents that you are getting from the property through. I'm assuming that you have a cost of capital. If you don't, then that's completely altogether different discussion. But you have a higher discount rate. So the offset for the discount rate is if you can increase the rents, and therefore that growth and the earlier topic on how you enhance the yield of the property. But typically for REITs and property in general, the growth rate is not as high as what you can get in other you know, sectors. So because the growth rate is not high, when rates go up, then you know, that impacts the REITs as well. And finally, REITs are bond proxies, so that's an opportunity cost. Why pay? You know, why get just 5% for taking all this headaches? You can just, you know, put it in the fixed deposits, U.S. You know, corporate bond market, and so on and so forth. So those are the 3 ways why REITs get more impacted by high interest rates than other financial instruments. I will show in the couple of next 2 slides how historically, you know, this sector has done. I think Singapore REIT sector still has a relatively small history. The longer histories are obviously US and Australian ones. So I have taken one example from US and then how the Singapore has done. What can offset is, again, going back to the topics which has been covered by Mr. Wong and as well as Adrian, as to how you can offset that, so you can increase the net operating income of the property itself. Not an easy thing to do, because you know what is it that you can do and your neighboring landlord cannot do, right? So it's a competitive market. But there are some, you know, if you have some contractual rent growth within your property, then yes, then that will impact. But again, it's like you are earning now, but eventually if the overall market doesn't improve, then the tenant eventually leaves at the end of the contract, then you will see a step down. So but then yeah, for the time being, you are still making more money. Anyways, you can improve your, the lease management, occupancy gains, rent reversions, and all that thing, and then scale efficiencies. Obviously, I think if you have 5 residential properties, then you can engage a cleaner and pay a cheaper rate for cleaning those homes versus having just one asset. So there are some scale efficiencies in having properties in multiple properties. But more importantly, I think the high interest rate environment, you tend to look at your property in a bit more deeper way. Because when it is a low interest rate environment, you look to grow bigger and bigger, right? When it is a high interest rate environment, the capital cost is high. That also brings discipline. So, what properties are really earning more than what you are paying to the bank, right? And then if it is something more that you can do to the property, or it is something that where you think that yields have already maxed out, you cannot generate more cash flows, and therefore you are better off to take some money off the table. And again, that basically is kind of what we say, this capital recycling opportunities. And there in this market, obviously the bid-ask spread is high. So what the seller wants to sell for and what the buyer wants to buy there's a big gap. So you can say that, okay, even if the gap is high, I am still way above my purchase cost. I have already made money from paying the banks, and then much more. I have made more than that. So even if I take a hit on my whatever was the last year's price of that property, I'm willing to sell off and look for higher yielding opportunities elsewhere. It is typically very difficult to do because it's a mindset change, and I think and if you are having a loss-making property, then more than risk-averse, you become loss-averse. So there is a behavioral impact as well. So, but I think typically in high interest rate environment, you do get an opportunity to look at the properties in a closer way and see what fits your portfolio and what doesn't fit your portfolio. So finally, I mean, what does it mean to your money and your portfolio? So I think I put it in four bullet points. The first two are, if you think that you have an edge or you perceive to have an edge, then you can see where the real estate cycle is, where the policy cycle is, where the overall policy cycle of the various governments are, and how the growth outlook for various subsectors is, which is what I think both Adrian, I think Mr. Wong from Cushman & Wakefield just had a chart on how the rents are there and how rents have performed for various subsectors from 2013. So you can do that work, and then you can come down one step lower and say that, okay, I particularly have an edge on one particular REIT. I know the manager there, I know the sponsor there, what the sponsor is trying to do, and so on and so forth. And I have some relationships where you can give me a better edge. Fine. So then I think you can have a bit more deeper look at that REIT and say that, okay, this, even if the interest rates are high, I think this will stand the test of time. So those are the two for where you have that extra knowledge from over the market. The other two are for the humble and nimble people. So once you say that I don't know anything, for me the most inexpensive one, the cheaper I buy the price, the better it is for me. And otherwise, other thing is that you don't know anything, you just trade the ranges, a little bit of money you are prepared to make, a little bit of money you're prepared to lose. Hopefully you make more times than you lose. So that's broadly it. And then there is a small thing, basically how we look at cash flows and how we discount that. But it's essentially what I have mentioned there in the summary page. So the next thing I will basically do over the next two slides are how the US and Singapore REITs have performed in high interest rate environment. Again, a lot of research already has been there, and it is there publicly available. So as I said, this is the REIT sector started from I think the late 1960s, and this is the data from 1975 to 2020. So out of 7 periods of high rates, it is 3 of them, REITs have outperformed the broader market. Which is not bad. But again, the periods in which they have done are the periods which have coincided with sort of high nominal growth, which means the inflation is high and your real GDP growth is also not that low. Typically, the rents for real estate properties readjust with the inflation, as you can see in the current environment in Singapore as well. And therefore, the real estate sector typically does well in the high inflation environment. Obviously, a lot of change from what was US in 1980s to what US is currently now. I mean, the amount of opportunities that is available outside of US, the amount of globalization that has happened, so all those things factors are there. But by and large, the REIT sector, if you have a high nominal growth, then real estate and REIT sector does do well, even if the interest rates are high. Similar thing we are seeing in Singapore, but as I said that Singapore is relatively new, and we have not really seen the inflation cycle that has been there in US. And by and large, the REIT sector in Singapore has been in an era of where Singapore dollar has been extremely strong. I mean, I think when we are talking about early 2000s, I think US dollar to Sing dollar was about 180, and from there we are now at about 135. So that has benefited the sector, apart from the overall the wealth management environment out here. Has also benefited the REIT. So there are sort of underlying other drivers as well, apart from just interest rates. And what I have done, because Singapore does not have an interest rate policy, it is more of an exchange policy that we have. So I have basically taken whenever the Sing dollar 10-year yield was high, as an corresponding period for high interest rate environment. So by and large, it's a similar conclusion that you have mixed performance during the periods of high interest rates. 4 out of 8 periods that have done well, and the remaining have underperformed the broader market. And you have, again, the periods when they are doing well are again periods of high nominal growth. And more importantly from Singapore, because there is a lot of financial flows happening here, it is more about the pace of the rate hike rather than the amount of the rate hike. So if it is a gradual pace of rate hike, I think the REIT sector can take it in the stride. But if it is more of a high pace of rate hike, what has happened recently is when the REIT sector is caught wrong-footed. So net, I think, yes, high interest rate is a detriment for the REIT sector, but if it comes along with growth, then REIT sector does benefit, and if the rate hikes are more gradual, what I think you have seen probably in the 2013 to 2018 period. If you remember 2013, there was a taper tantrum in month of May when the REIT sector was down 20%. But then after that, the next hike was, I think, in 2015. So that gave a lot of time for the REIT sector to adjust its performance and its overall characteristics. So those are the two things which I wanted to kind of highlight. And on a lighter note, typically these kind of events you end up calling the top of the cycle, interest rate cycle, or the bottom of the growth cycle. So if either of those two things pan out, then the REIT sector is not too negative at the current juncture. The next slides that I have is basically what Mr. Wong had already said, but I have put through in for each of the individual subsectors, because as I said that one thing which can offset the impact of interest rate is the growth in net operating income. So if you can increase your interest rates, increase your rental rates, then that offsets the interest interest expense outgo from higher interest rates. So that is something which has I think benefited Adrian's sector. As you can see, the industrial rents and price indices have been growing through the pandemic, and this is probably one sector which is above the pre-pandemic times in terms of the current spot rents and the current prices. Obviously, there is a bit of a debate whether there are structural factors to that, or it is just the COVID-related impact. But that is something that if you are seeing that this kind of an rent growth, then as you are seeing that that so far now, except for this current quarter, the industrial sector has been able to deliver higher DPUs. But now I think the impact of interest rate is catching up with them as well. The next slide is on the office rents and price indices. It shows that the rental index has gone up above the pre-pandemic, but there are as Mr. Wong said, it's more of a two subsectors. One is the grade A flight to quality, and then the grade B offices. And if more transactions are happening on the grade A side, then obviously you are seeing a higher increase in the rents, but that probably does not reflect the overall state of the office sector. Moving to retail and then onto the hospitality. Retail, I think it has gone through the impact of the prior disruption, e-commerce, and then subsequent COVID and the change of shopping habits. And you can see the impact there both in terms of the price and rents. But if you are kind of a view that everything mean reverts one way or other, then that's probably a sector where you can see that can have some cyclical growth. But will all properties, or rather all boats, kind of rise? I mean, that is where I think somebody needs to do the work on there. And hotels, I think, doesn't need much introduction. We all know what they are doing. Room rates, occupancy. I think occupancy is still below, but the room rates are higher, and partly because I think the supply is very dynamically managed out here. And you can see the demand and supply situation where visitor arrivals are still about probably 20-25% below pre-pandemic, but I think the supply is about 6-7% below the pre-pandemic. So I think that shows that the hotel room rates have done what they have done, and if the room rates can go up more, then do we need? Is there more demand for that, or do we need to reduce the room rates to push up the occupancy? The next slide basically summarizes everything, and all the stats, which is the supply pipeline, is all from JTC and URA. The growth assumptions are Maybank's. So what the point basically I wanted to highlight is the supply for retail, which is really low. But again, the sector is and will face disruption. And the second is, I think, that I wanted to highlight is on the growth for the RevPAR for the hotels, which is the rents for hotels, is where we expect the highest growth. There is more that I have put across for other subsectors as well, but what I basically wanted to highlight is in high interest rate environment, you need to look at the rent growth as an offset for the interest rates. Finally, I will touch on what Adrian gave me the responsibility about outlook, very tricky one. So I have relied on our in-house economist for his views. So the changes that we have done is we cut our 2023 growth forecast. I think second half, probably can be a bit higher because we're expecting about 0.8%. So second half probably could be quite higher, but the key point I think is we are expecting inflation to stay high for longer. We lowered our 2024 forecast, 2023 forecast, but then we increased our 2024 forecast. So it is a bit more high for longer kind of an environment in terms of inflation, and therefore it will also impact the interest rates as well. We do expect the interest rates to be lowered in 2024, but so far I think our predictions were similar in 2023, which didn't pan out. So we need to see how the inflation dynamic kind of works out, and if yesterday's commentary in Jackson Hole was anything to go by, it looks like the prevailing thinking is that inflation is going to be sticky. The charts on your right are basically how much of dividend yields you are getting from the index, from the REIT sector over and above the 10-year Singapore bond. And in my opinion, I think the yields are still quite tight for the Singapore REIT sector. I think bonds are a lot better. And same thing is for the chart below, which is for the index dividend yield versus your corresponding investment grade bonds. Again, the same thing that the bonds are better than your Singapore REIT sector at the current thing. So the question typically comes is, why is this situation and why has it prolonged so long? Because everyone is looking at the same numbers. So some thoughts are that, as I said before, that real estate is an inflation hedge, and more so in Singapore, where supply is very tightly controlled. The other is much more, I think, to do with the market dynamic, that not all people who invest in equity can invest in the bond market, because you have a higher threshold there of 250K. So it is really a segmental liquidity which is driving this kind of a difference in the yield environment. So those are the slides that I have. I am sure you will probably have more questions later on. But to summarize, yes, the interest rates do have an outsized impact on the REIT sector versus other sectors. But having said that, you can offset the impact by raising the rents, or if you can't do that, then you basically go enter the sector at the price at where you think it is really inexpensive. On that note, I will just end it, and thank you very much for your time.
So, good morning, everybody. And I had some questions ready, but we would rather answer your questions first before we get to the questions I have. And the first question has to be answered by Adrian, because it's about his debt. Now, I do know that they raised 630 million or something like that earlier on this year. So we're going to ask him two things. What's he going to do with all that money? Because we don't have any. What's he going to do with all that money? And this debt question here.
Yeah, so thanks, Gula. At the start of the year, we raised $300 million. And then recently, we sold $330 million worth of assets, short-term non-core assets, for about $330 million. So total about, technically, I have a $630 million in my piggy bank right now. It's good to be in this position, but I think what we have is that, just to recap a little bit, the $300 million that we raised earlier this year has already been identified for a redevelopment project that we want to do. So I think part of the money has already been used to that. The question then is, what about 330? What are we going to use about that? Yes. We sold this asset not because we are in financial distress. So I just want to take you through. It's because we look at it non-core, short land lease, less than 25, and people always think that $330 million is actually one asset. No, man, it's 5 assets. Each one is only $60 million, short land lease. So we sold that. So we're going to use the money in the meantime to actually pay down debt first. Yes, you're right, $505 million in 2024. So bulk of it will be used to pay that, and then that will become about 100 mil. We are using bulk of that to. So the 500 million is made of what we call an RCF, a revolving credit line facility, as well as a term loan. We're paying off the more expensive term loans. So we're left 100, and then in left 2024, 100, no problem. I mean, and then in 2025, we have another $180 million, which is not a lot. So dollar value is quite a lot. But if you look at percentage, as a percentage of my total debt, so after I pay off 2024, left 100 mil is already about 5% of my total debt. And then 2025, 180 is only about 9%. So technically, I can share with you that after I pay down the debt, I have no major loans to pay until 2026. So hopefully, and I'm really praying that the higher for longer interest rate don't go into 2026. Yeah.
Okay. So the question I have, which is not here, is that you've identified a property for AEI, which will take more than 200 million, the bulk of that 300 million you raised. So what will be the ROI? I know this is a sensitive question for you, but will that be more than the the yield on the yield on?
Yeah, I mean, we have always been looking at our AEIs and redevelopments and looking at about 7 to 8%. Nothing has really changed right now because when you do redevelopments and when you do AEI, bulk of the yield returns comes from cost of construction. And I just shared with you construction, expense, inflationary pressures put pressures on maintenance, but it also costs construction costs as well. And construction costs, I'll be very honest with you, has gone up pre-pandemic by 30 to 40%. Okay, what is good for us is that because we do redevelopments at AEI on our own assets, we don't need to pay for land. The land is ours already. So that's where we saved. So what you see is basically pure construction costs on the building. And that's why we're still able to maintain about 7-ish percent based on our expected rentals that was done in our feasibility studies probably last year. So if Krishnan is right, and I hope he is really right, and that maybe when the time and the buildings are ready, we could able to maybe push a rental a little bit more when we rent out. Yeah.
Okay, that's good. All right, so oh goodness, okay, so as he was talking, we've had the top questions are, what can we learn from Manulife REIT? And I don't know which one to take first, because Krishna says he's not going to answer individual REITs, and Adrian can't answer about Manulife REIT. Will you be able to say, okay, look, he's going to say something about the difference. So Manulife REIT, we're going to take a few minutes on this. The difference between the office sector in the US versus the office sector in Singapore. There are a couple of differences. One, of course, is the paradigm shift we've had since COVID. And the other one is, they need more tenant incentives, et cetera, et cetera. If you could address some of those. So Xian Yang's going to take that one.
Yeah, okay, thanks, good.
9 votes. I got 9 votes now.
The target board. Yeah, okay, so maybe for the office sector in Singapore versus, say, the US, I think it's really quite different, right? I mean, post-pandemic, I think the key difference is really the work from home, right? And also how that is playing out in Singapore and US. And you might imagine, how come US REITs are doing so much more worse, and yet for Singapore, right? You look at office valuations, right? It's still stable or even going up, right? And so there are a few key reasons. One is also the return to office for Singapore is really quite encouraging, right? We estimate it to be about 70 to 80%. So there is it's like a pendulum swing, right? During COVID, I think everyone worked more people from home, but now that things have opened up, right, and there's more, I would say, more concerns about pandemic is sort of faded away, right? It's more focused on productivity, right? And people are coming back to the office in Singapore, and Singapore is, I think, our size also plays to our benefit, right? In Singapore, right, even though I could stay in Pasir Ris, I moved to Jurong. In the end of the day, if I go to CBD, it's still the same distance, right? And then that takes half an hour, 45 minutes, come to office. But in the US, right, especially in some cities where cost of housing, like maybe say San Fran, right? During the pandemic, a lot of these people they went back to more suburban areas where the cost is much lower, right? And they've made decisions like for their families, they found schooling for their kids and all that. So you ask them to come back to the office and suddenly pay much higher rents again. I think there will be a lot of resistance to that. For Singapore, it's just a 45 minutes difference. Which direction you want to take, right? So our size does help, and it's easier to get people back to the office. And with people also coming back to the office, that has kept occupancies very high. Right? If you look at the CBD Grade A office, our vacancy rates are less than 5%, and it's very low as compared to the other markets where not as low as I think Japan. Tokyo is a bit lower, right? But in the region, we are one of the lowest already. Right? In other markets, like I think Australia, I think it's much more than 10-20% kind of vacancy rates. So that has helped, kept our I would say the outlook for the office in Singapore is much stronger, right? And and also there's also company relocations into Singapore as well, right? Because Southeast Asia is like one of the fastest growth regions, and Singapore is like a gateway to Southeast Asia, right? Some say it's a proxy for Southeast Asia growth. So you're still seeing that relocations. No doubt demand has slowed down as compared to before because of the high interest rate environment. Right? People are more cautious, but yet vacancy rates are not really rising meaningfully. They're still quite low, right? As opposed to, I think, the US, where vacancy rates are much higher. So that has a lot of impact in terms of, I would say, their valuations, and compared to Singapore, where valuations have, largely kept stable.
Okay, thank you for that. So that's the difference there. So I guess what he's trying to say is best to invest in REITs with most of their properties in Singapore. Is that what you're trying to say?
I didn't say that, but
You didn't say that. Oh,
That
sorry, I can't put words into his mouth. But anyway, Christian, do you have anything to add?
Yeah, I think so. My view is that I think this hybrid working will be there to stay. Singapore things happen slowly, but they do happen eventually, right? And within that time, there will be periods like what we have seen probably in the housing sector. Supply, you take out the supply and you squeeze the rent, and suddenly office will be the best sector, right? So I think, but the broad trend towards hybrid working, I think will be there, and I think it does few things. I think the pressure on the infrastructure, how much of roads and how much of rails do you really need? It's a planning parameter, and that addresses that. That's first point, right? Second is, and especially for a country where land is a bit of a premium. And the second is that work-life balance that I think everyone talks about, right? And finally, I think to the support that offices will be there is depends on what kind of work you kind of are doing. So a lot of the flow businesses will continue to be done, I think, without office. New projects, new client onboarding and stuff, I think that will need office. So I think that if you are really talking about physical occupancy of offices, I think they will remain low, but that does not mean that that the offices are not generating revenue because the rents are the clients are, the tenants are still there. I think that is what I probably will talk about Singapore. Yes, I do accept that Singapore is not US. US has different dynamics. But I think two things which I will say in support of the US office sector, because right now I think the environment is very much against that. So I think just to balance that, a few things. I think one is if you look at the new build supply in US, I think it has dried down. And again, there is no rocket science. If the banks don't fund, then you don't build, right? So that's one. And then I think in some cases the conversion of those offices have also started to begin. Existing inventory will take some time to work out through, but I think that those are the trends to monitor. And the second thing, I think in some of the briefings with the Fed, they did say that for the bank loans which are supporting those assets, the resolution is going to be essentially like the TARP program, the Trouble Asset Relief Program of GFC, which is a template that was set there. So there is some light at the end of tunnel. Obviously, I mean, the TARP was supported by taxpayers' money. What supports that needs to be seen. Obviously, the amount of commercial real estate debt is not as big as the housing debt in US. But at least there is some talk or some thinking about how to resolve the balance sheet side of the banks which are supporting those assets. So those are the 2 points I just wanted to highlight.
Okay, thanks. I think Adrian's dying to say something about office.
Nah, I know this. I'm not going to comment on REIT, but when I read this question, apart from office sectors and all this stuff, I think there is a question between the lines. And I think that one of my thinking is that this question is about how to solve the problems that they have right now, especially in view of sponsor.
Yes.
That's what I think there is a
right.
Chinese say 话中有话 kind of,
Translate that for
yeah?
some of us.
So I think I believe that is what in between the lines, and that is. And I give you my take of. I'm not saying. Please don't take it that I'm criticizing any REITs or whatever, right? This is really real generic. I've been in this market for 20 years. I have different roles in the REIT market. I think the key question is sponsor. Very simple. Sponsors
of REITs play an important role. And why do you need to have sponsor? It comes down to 3 fundamental points. Asset pipeline. Okay, and the quality, what kind of asset pipeline that they can tell. Number 2, financial support in times of growth and during bad times. Right? In times of good times, you can borrow from everybody. Everybody is eager to lend you money. But it's in the bad times, who is ready to step up? So financial support is that. Not just the good times, the bad times, provide the financial support. And number 3, and then in part of financial support is, can they help to bring down costs? Okay. Number 3 is the support that they can give you in managing and running your assets. Because especially if you want to go overseas, if I don't have someone to tap onto, that means I have to go to the country and set up everything from scratch. Who do you think is going to pay for the offices, the setup and everything? The REIT. But if you have a sponsor that's already there, has on-the-ground people, you can leverage it on that. So these are the 3. Now with these 3 in mind, that it becomes your sponsor does have the ability to provide these 3. So if you're a developer sponsor who has a whole business of developments, property management, funds management, I think you can fulfill these 3. But if you are what we call a financial sponsor, right, who basically are a fund manager of mutual funds, where are you going to get the assets? Are you interested in setting up property management teams in the countries? You have your office there, don't get me wrong, but what are people there? They are basically fund managers. They are not property managers. And if the time gets tough, as I said, in a good market, everybody wants to lend you money. Everybody gives you money. It's like umbrella, right? You know, sunny day, everybody give you umbrella. Rainy day, everybody take back umbrella. You know? So you got to ask yourself this question. Will that sponsor, in a rainy day, going to pass you the umbrella or actually going to snatch the umbrella from you? So I think it comes back down to this question. And I think this question is trying to ask that. That's my view. I mean, I may be wrong. So I'm just being honest to say that. Let's go back to the fundamentals. What are the 3? And then evaluate whether your sponsor can provide that 3. And that's where I guess it comes from.
Okay, thanks. That's very useful. So I was going to call on Jovi because he wrote an article in the beginning of 2022 on Manulife US REIT, where he pointed out that its distributions were falling despite its AUM growth. And you said the AUM had grown how many times? 2 or 3 times within 2 years or 3 years? Yeah. So perhaps that's the fast AUM growth. That was one thing. And the non-accretion, perhaps, of that growth. That's the second thing. So what can we learn from it? Well, I guess everything goes down to the property, how the properties perform, and whether they can continue to perform. So perhaps property management is very, very important. Would you agree there? Property management, yeah. And so your property management company becomes very important. Agree on that one, yeah. Okay, so that's one. And in the Singapore context, a property management company usually belongs to the sponsor. We all agree on that one. Okay. And the third, and I suppose there's the other point, of course, is the support from the sponsor. So in the case of Manulife REIT, this is probably the test of the support of the sponsor, because the sponsor has stated that it's going to come in to buy one of its assets, to buy one of the assets and to ensure that the expiries of 2024 and 2025 are taken care of, and it will it'll also provide some credit to the REIT. So in that sense, you've got to test. This is a test of the sponsor and the external management model. That brings us to the next question, which has 10 votes now, where it says Singapore REIT managers are owned by their sponsors. So we'll stick to that. And they tend to focus on growing management fees rather than DPU for investors. Now, hang on a minute. We've got a manager here. Are you focused on growing management fees, or are you focused on growing DPU for your investors? Because if I remember right, your largest cost is not the management fees, it's interest costs. All right, so what do you focus on?
Yeah, exactly. The key is on DPU, because managers' fees is not the one that's the largest. It's actually interest costs as well as property expenses. And these are the ones that is actually big. And I think people like to see it as one context. DPU drop, fees goes up, so they are not aligned. I think it goes beyond that. You also got to look at what the sponsor stake. If the sponsor if it's this first scenario, they say DPU goes down, interest rate goes up. Interest rate goes up, fees goes up, and then you start to see that the sponsor has also been selling down the stake in the REIT. I think that is a direction of alignment. But if you see that the sponsor stake has always been increasing, or in fact, other things that they support, as for example, fundraising. People criticize fundraising and say that you create fundraising so that you get more money and buy more properties and AUM increases and more fees. But does people see whether the fundraising, who is supporting it? So if you have a fundraising, and if you do it by what you call a rights issue, the truth of the matter is someone needs to underwrite it. If you ask the banks to underwrite it, it's a rights issue, 2 weeks exposure, they will tell you, I want a big fee for that, because I underwrite at this price, and then when 2 weeks later, the share price may be lower, and I get stuck with it. So who is paying for the underwriting fees? Actually, it's unit holders. And at the same time, they want to ask for a big discount. A big discount will make a transaction that is accretive become dilutive. It's very simple, because the cost of funds has just gone up with a big discount. But if you have a sponsor that is willing to come in and say, look, I put my money where my mouth is, I will backstop the whole rights issue. Right? And you guys go and take first. If you guys don't like it, don't worry, I'm the backstop. That is alignment. Because if you do a rights issue of $100 million, basically the sponsor is going to take $100 million on the stake. And you can have a first cherry of the bite of the cherry, sorry. And then you see it. And then at the same time, because the sponsor backstopped the whole $100 million, they need to pay underwriting fee to the banks. So it really comes back down to the thing is, how aligned is the sponsor? Not just from the fees. People like to think that fees is a replication of alignment. But you must look at other things. Has a sponsor, what has a sponsor done to you? Has a sponsor in a fundraising does a backstop? Do they even take up their pro rata rights? If they don't even take up their pro rata rights, I think this is a question of what is alignment. What is their view of that investment? Because remember, sponsor sits on the board. They have all the information and all the board papers and the investment criteria and information that they have before you guys have. So if the sponsor decides not even to take up the pro rata stake, the sponsor don't even bother to go and take up this backstop, I think it's a signal of what they view, what is their view of that acquisition. That, to me, is the alignment. You can make $1 million from acquisition fee from a $100 million fundraising, but if you are not aligned, your $100 million gets hit. You can lose $10 million overnight when after the thing gets listed and comes down. So I think people need to look at that perspective.
Yes, indeed. And on that score, I must say something in defense of Manulife US REIT, because we're coming back to that. The sponsors only allowed, well, any individual investor, including Insti, is only allowed 9.8%. So that I think you can't, they can't underwrite equity fundraising. So that was that point there. Now, the second part of that point, that question that's got so many votes is, do you agree REIT managers should be owned by the REITs? And yes, I do. I would say I like that point, and I think I do believe that REIT managers should be owned by the REITs, because I don't believe that they should get so many fees. I hope you don't mind me saying that. But I do have some data points, because I have covered Link REIT, yeah? And I do notice, if I remember, I thought that the NAV was something like $70 Hong Kong dollars per unit, and it was last traded at $38 per unit. So there's a huge discount to NAV. So that's one point there. It's also down 31%. This is an internalized REIT. It was born internal, as they say. It's down 31% year to date, and but I will say this about, in defense of it, its cost as a percentage of its AUM is only about 0.47%, basis percent, 0.47%, versus, well, the biggest REIT here, so it's got 43 billion equivalent, Singapore dollars equivalent of assets, compared to our little CICT, which owns this building. CICT only has 24 billion of AUM. Small, isn't it? Small, aren't we small? Yes, we are. But that's declined only 6% year to date. So if you wanted to talk about internal versus external in terms of returns, then you could see better returns from this little fellow here, CICT, which is a small REIT. It's down 6% year to date. Its yield is about 5.8% based on an outlook. You know, if you double up its DPU, Link REIT would be a bit more, 6%. And I think it's down quite a bit this year because it had to revalue downwards a property called the Cabot in Canary Wharf in London. I think it lost $1 billion Hong Kong dollars on that one. Yes. So I think does that cover it, internal versus external? So I think it all comes down to the property and how you manage the property and who your property management company is, rather than just the sponsor and just the fees. Yeah. But I do believe that REIT managers should be owned by the REITs. You want to say something? You want to say something?
Yeah, I don't think there is right or wrong answer of whether it should be REIT managers who own the REIT or an external model. The answer is still very simple. If you want the three things, pipeline, financial support when the shit hits the fence, as well as proper management of your assets as you go overseas, you may not have that if you're internalized, because then the manager, the so-called sponsor, is just...
There's no sponsor.
There's no sponsor.
There's no sponsor.
Right? So whenever then you go and do the rights issue, you will be getting deep discounts. You're going to pay underwriting fee. And if there's an asset that the so-called ex-sponsor wants to sell, you don't have the first cherry buy. And you don't have the information. The good thing is that when we buy assets from our sponsor, before we even put out to you, we will probably know the asset information inside out, because it's within the family. So the point I'm trying to put is that you can't have your cake and eat it. There are offsets, and it's just like us parents, right? If your son doesn't want to take your surname, then you don't have to stay in the house.
Oh, don't be
it is,
son.
right?
Don't be
You're
his
not
son.
going to be,
Don't be his son.
you're going to be not going to get food on the table, and you're going to go and fend out yourself. And the world outside is getting more volatile. So I think if you ask my frank opinion, there's no right or wrong answer. There are some internalized REITs that's been successful, not just Link. I mean, in Australia, in US, there are. But ultimately, it really comes back to what you really want. If you want the safe harbor, that when things goes wrong, when the market is a bit tough, and then you have and at least for my sponsor, even it, as a sponsor, they have the assets. I like those assets, but they are also a listed company. There are also other people outside competing with me for the assets. But it's just that I have better relationships. I talk every day to my sponsor. I have more information than it is. They will sometimes tend to want to keep. Good properties, you always want to keep your heirloom within your family. So generally, if the price is not that far apart, they will just keep it together with us. But once you are not a sponsor, once you're internalized, you're no more a sponsor. Then the proposition does change a bit. So I guess there are trade-offs.
Yeah. Yes, but the other point, of course, in defense of Link REIT, I must say, there is no conflict of interest between any sponsor or Link REIT, and they buy a property based on the merits of that property. But sometimes, they didn't buy the Cabot at. They bought the Cabot before the interest rate.
Same as us, right?
And
it's very clear in IPT rules in Singapore that is an IPT sponsor cannot vote. So that conflict of interest is actually addressed. The sponsor cannot vote. The independent shareholders are the ones that decide whether you want to buy or you don't want to buy. And after you've decided whether you want to buy or don't to buy, you need to fund it with a rights issue. Guess who has the first cherry bite?
So, yes. Okay. So, all right. The other point about internal versus external, I noticed the unsaid word, and these people can't comment on it. The unsaid word is Sabana REIT. I do notice that when the requisition for the internalization of removing the manager came out in early June, was it? Early June. I think it was at 44 cents. And, well, it's a bit lower than that now, isn't it? So that's just an observation. I mean, it's a factual observation, so no one can accuse me of being partial. All right. So SGX listed REITs with foreign assets are doing badly, and that one's also very, very popular. SGX, there you are. And are doing badly as values decline in the US and Europe. Some are at a fraction of IPO prices. What strategies can we adopt for investors? I'm so sorry, Krishna. I really, since you were quiet over the other part, I have to come to you. They're talking about strategies to adopt. They're not talking, can you answer that?
I guess. Okay, so I think you know your home the best. That's what I will kind of put that. Now I get that the Singapore is a small place, so I think you are forced out. But I will say I think either you know the asset or you know the sponsor when you are going outside. So and then coming to your question, answer the question that what strategy to adopt for investors. So if you are comfortable with the price, the discount that is currently available, and you know that redemption is pretty soon, then yes, then obviously there is an opportunity. But I think I will go back to where I started from. You know your home the best. So yeah, I think that's what I would say.
Yeah.
Jiang Yang's going to say a few things about property we don't know. European, US.
Yeah, so I guess also, so one thing I observe is like in terms of repricing opportunities, right? There's much more prevalent in the US and also in the Europe, right? In APAC, I think things have not really repriced, and also because I think they are facing quite different headwinds. Like for example, in Europe, I think there's inflation. Like US and Europe, inflation over there is much higher, right? And also interest rates are also more likely to go up, as opposed to like in APAC or the region. So I think there's really different multi-speeds on where it's going, right? Like for example, like China, I think interest rates are actually coming down, right? And that is also, but China is more on a demand issue, right? So in the US and Europe, I would say, so it depends, I think, for an investor, where you think we are at the cycle. I mean, it's come out a lot, so whether you think that now it's getting to be a bit more like in terms of value, right? It could be a long-term value proposition, right? If you already invested it, then you don't want to be caught in, when things recover, then asset prices recover, right? I think it's all about cycles. I really don't think it's we're gonna go down all the way, right? There will be recovery, and so it's all about holding power as well. Right, whether you can hold on through the cycles, right? Because eventually, I think in the US and Europe, right, we would see. I mean, the recovery will come, and probably it will be characterized by the flight to quality. I think that's the enduring theme that we will see, like the flight to quality and also to sustainability. So I would say, REIT with this kind of good quality assets, right? These would see, they'll be the front runners of eventual recovery.
I want to make a point also about these foreign REITs. Okay, I think there were declines, significant declines in our US REITs, all of them, whether they have met, they're at the 50% or above the 50%, or their covenants have been affected. And that is because even the non-Manulife US REITs, such as Keppel Pacific Oak and Prime, have debt expiries in 2024. And one of them is a mortgage. I think Prime's probably a mortgage, and I think the issue is the valuation of the underlying property, which may be revalued downwards. In which case, I don't know how it will affect their mortgage and what the covenants are with the banks, because they won't speak to me. Maybe I'll send Jovi. Right. The second point is that Core also has an expiry due in 2024, which is about 12.9% of its total debt. So perhaps those are the reasons that those have come down. So they're idiosyncratic reasons. It's just specific to the valuations of those U.S. assets. As for the strategy to adopt for investors, well, to be honest, I was looking at Manulife US REIT because its market cap is like 140 million now, and it's got 133 million of restricted cash on its balance sheet. So the properties are actually free. But then, oh my goodness, then I keep on seeing the share price come down. So, you know, I just went for those 6-month Singapore MAS Treasury bills. Do you have something to say? Oh,
I don't know how. I mean, I cannot come from a asset owner perspective. I think Mano's question is. I think from Mano the question. I think I can share only from a manager's perspective. Okay, because whatever Mano's mentioned, like values decline. If we also invest in it, we also exposed to that. So I share the same answer, the same view as Krishna, who says that you need to know your own market. But I guess you need to, when he says own market, it doesn't mean it's Singapore. I think you look at the sponsor as a group, the REIT and the sponsor as a group. Globalized or Asian-focused companies like ESR Group, to us, Asia is the home market. Right? So because we have operations there in China, in Australia, in Japan, you know, in all. So in Singapore. So these are our home markets. So when we invest in these countries, we have our own people on the ground. We know what's the pulse. We know what is the funding ability that's able to there. We know if there's any tax changes that is coming. And if in our view, if we believe that we have that intel, it's enough that intel, then we will then invest in these countries. Because real estate is a longer game. As Xian Yang said, there are cycles. We have 10 years of low interest rate environment. Now we are in probably first year of a high interest rate environment. What comes down will go up. What goes up will also come down. But at the end of the day, you need to know that the assets that you buy, whether it is Europe, whether it is US, okay, the assets that you, I correct myself, the assets that you buy must be in your home country. And if your home country is in Asia, and when I say it's home country, it means you must have all your management and team all set up from a full real estate valuation, from development, investments, property management, and all. That is in your home market. And then that is where you can see the best assets, you buy the best assets, and then that is where I believe that you can ride through the cycle in a longer time.
Okay, thanks. Thank you for that, Adrian. So there's another question. This is on SGX property developers. I'm not quite sure who to ask about this, but maybe it should be Krishna again and then Xian Yang on the underlying assets. SGX listed property developers are trading at steep discounts to their NTAs. So big groups like Hobie, Wing Tai, and Walco Land, they pay dividends. Are they safe and good bets at current prices? Well, I don't know whether he'll have to. He can't answer directly. He can't say yes or no.
Yeah, so I think there is a bit of a difference between how the REITs and the developers are structured, right? So REITs do have a small playground to play, and therefore the way they allocate the capital is a lot more constrained. And I think as an investor, probably you can analyze that a lot more in a lot more better way. Whereas for developers, at least, I mean, in my limited intellectual bandwidth, I struggle with their the way they allocate the capital, looking at the balance sheet, and then unpeeling the associates and JVs. So. So I think that discount has been there for a long time, and the market knows. But having said that, I think, yes, the interest rate environment has changed. So one versus other, I mean, what do you go with? Yes, if dividends from the developers are high enough and they have demonstrated a history of good capital allocation and good execution, then definitely one can look at that. But having said that, I think, yes, you are getting the comfort of the REITs in terms of their stated payout policy and the capital allocation discipline that they are forced into. That's what I will kind of say.
Okay, thanks. I've often wondered, yes, because is it because the developers have a lot of assets, I mean, property assets, and they're not very liquid? Is that why they are trading at discounts? I mean, what's your view on? And all these are basically, I mean, they've got mainly Singapore assets, except for maybe Hobie that bought into London with the Shard or something. They buy the Shard. Anyway, yeah. If you could,
Yeah. So to me, it's really, it's the perception on, because these are listed stocks, so their prices actually reflect, the perception of, I would say the underlying property, and also it also affects, I would say, capital allocations, right? So it's a bit different from, say, a valuation on development, where, so valuation is really based on the valuer's view on the future outlook of the property, right? Which is, based on, now interest rates are high, they have adjusted the cap rates, discount rates higher, right? But if it's still very well occupied, there are not much, there are no transactions, right? Market transactions that actually, say, maybe, you don't see offices in buildings trading 50% from the valuations, right? It's all, actually there's no transactions because owners are not willing to sell at a discount because they're still doing well, right? But buyers, because of the high interest rates, it's very hard to get it past their investment committee, right? So, but for public markets, right, because, it's more liquid, right? So liquidity actually, that is, I think that's really one factor why there is the discount, because for their current yields or their current dividends, right, for some they could choose to, I can invest in 10-year US Treasuries. Maybe the yield is better and it's more risk-free, right? So that allocations does pull away, I would say, funds from say such stocks, and that affects the stock prices. Yeah.
Okay, thanks. Adrian, I don't know whether you want to answer that question next to it. This one. This one? Sure. No, this one.
I hope so.
Okay, all right.
If I can add,
Okay.
I could add onto this question that I have. I think ultimately it comes back down to, as an investor, what is your investment objective? If you want stable distributions, there's very clear rules. What you can buy, what you cannot buy. I must pay out dividend. This is at least 90%. And at the same time, because I pay out 90%, I don't need to pay corporate tax. And if the dividends comes to you, you also don't need to pay tax. Simple rules. Because it's simple and boring rules, that's why you only get the yield. Then you go for it. But if you're the guys that have very good risk appetite, I want to ride the cycle, I want to find the most bottom one, and then I go in, I do 30-40%, then groups like this may be helpful for you. But back to your risk appetite. And then, but then you got to live with it, that groups like this, they are not just single. They do resi, they do hotel, they do London, they do everything. And the information that you're going to get is not going to be as transparent as what a REIT is going to do. Whereas for a REIT, it's quite simple. I am an industrial REIT. I'll give you all the information that you need to know about industrial, and all my resources is all focused on industrial. Whereas bigger group, same resources, but maybe be spread thinner around. So it's the simple 101 of finance. Simple, boring means low risk. It means the returns is expected to be lower. You want high risk, means that there's more complexity, more information for you to look at, then you get a high return. So it depends on the risk appetite. That's what from my take on this.
Okay.
Yeah, I'll just add one last point probably for these developers. I think through the period, I think land banking has kind of gone away for the Singapore developers because of various government policies. So if you are not really land banking, then what exactly are we buying the developers for? So it is basically then your execution of the land that you purchase, and then you execute that and sell it. So the valuation paradigm does not become your book value, but more of earnings. So if you are getting next year a big earning, and the government and the developer has promised to say pay out 30% of that, then you get a a cash flow out of that. So I think that is other point which I just wanted to highlight, that from say 20 years back when developers were having land bank, the legacy land bank has more or less gone, and you are now just be getting land from the GLS. So that's something which I think we need to just keep in mind.
Okay, thank you, Krishna. Okay, so I've been told that we are running out of time, so we'll take 3 more questions, 2 of which will be answered by Adrian, and the last one will be answered. Sorry, the last one will be answered by Xian Yang, because that's on outlook for residential property and what we should buy if we have enough money. All right. So the 2 questions. The first one to Adrian. One is on why he raised funds, and the second one is on short land lease in Singapore. And that one, I think you'll have to also come in on that, because there's a question here: is everyone going to Johor? Yeah. All right. Right. So it's 6 of one and half a dozen of the other. You go to Johor, eventually your valuation comes off because of the currency, doesn't it? All right. So there's this question about, why did ESR REIT raise funds from this placement and the rights issue, and it's been divesting assets as well? And is it to fund the takeover of Sabana REIT? Well, that's what I want to know too.
Well, the answer is very simple. We tried to merge 2 years ago. I was rejected. Unit holders voted. I wanted to go for a nice lady, but I was rejected.
And that's it?
That's it. Unit holders spoke about it. They don't like the price, then we did. I have a view of what the value is. You don't like it, you reject it. I move on with life. I cannot keep crying over the fact that I have lost. I want to go after the girl and I couldn't get it. So the placements and the rights is very clear. The placement was used for redevelopment of a asset. And we see that demand. So the placement bulk of the fund was for a redevelopment that we want to do, cold stores facility. We are still looking at the parameters as well as the thing, but we definitely want to redevelop because land leases are there is long, returns will be good for that. The divesting of assets is clear because the land leases are short. Very clear. And I know we'll come to that later, but the problem with Singapore real estate for industrial is that actually we have our hands tied behind our back by 2 things. Number 1, underlying land leases are short, and number 2, the rules are very onerous as to who can buy and invest in Singapore industrial. I give you the second part. Unlike office, hotel, or retail, anybody who has $500 million, $300 million lying around can go and buy a shopping mall or a strata office or an office building. In Singapore, you can't. Even you have $500 million lying around, you cannot go and buy a factory or a warehouse that is sitting on JTC land because there are requirements of who can own it. That means basically either you're an end user, the guy who used the space for production, or you're what we call a CMS licensed entity or a REIT like myself. So which means that when you want to sell assets, there is a limited pool of people that you can sell to. And everybody knows everybody, right? So that is actually another constraint. On top of that, when we want to lease out space, unlike office, you can lease out to anyone as long as the guy pays you rental, right? Okay, you can't have a casino inside or like gambling den inside. But other than that, you can. But for us, industrial, we can't. We have B1, B2, who can go in, who cannot go in, and you have anchor tenant rules, you have everything you want to renew or even lease a new building, you got to go to JTC. So that's the reason why I think we have taken all this into considerations, and importantly, the land leases are getting shorter. We divest our assets because it's better for us to divest now than sitting on it and then see the value comes down and then get criticized to say, oh, you're not selling assets, Adrian, because you want to hoard the assets so that you can earn fees. Again, come back to that. Right? So we don't. We basically are not asset hoarders. The underlying assets are non-core. You cannot do asset enhancements. Those that I can do asset enhancements like the redevelopment that I mentioned, I will do it. I will do it. Those that I can't, I might as well sell it. And I always tell people, many years ago, if there are big online chatter about HDB leases of 60 years, what can happen, what cannot happen. Guys, our sector is 30 years or less. I think that is even a bigger issue that we got to manage. And so that's why we have to divest those assets that we cannot add value. We know the land leases are dropping. That is why we divest that. Even at a small discount, go for it first. Because if we wait and interest rate do not come down, cap rates goes up, discount rate goes up, your valuation will come down even more on top of the fact that your land leases are dropping.
Okay, thanks. So the next question, of course, addresses that. Given the short 30 years lease in Singapore and increasing connectivity with Malaysia, particularly in Johor, what trends are you seeing? We have to ask Sian Yang, are people moving to Johor to get freehold land? For industrial, right?
Yeah, so I would say, so for industrialists, I think they would assess, what they have a site selection criteria, right? And where Singapore outperforms, I would say, is really in our infrastructure, right? In terms of during the pandemic, right? I think our ports was, it was the top in terms of transshipment, right? Top in the world, and our ports were open all the way, right? This one, right? So occupiers, when they come to Singapore, they are assured, in terms of regulatory, I would say operational stability, it's always there, right? So that's why Singapore is definitely not cheap, right? And also, as what you said, our land leases are short, right? But yet, you still see that demand, even from logistics, coming to Singapore, right? And as Joe will probably know, right, rents have been going up, right, and going up quickly high because supply is really limited, right? So even with all these factors, right, Singapore still, I guess, we are seen as stable, right? There's this, especially in the world where it's very uncertain, right? Safety, there's the flight to safety, and for occupier, especially if you're in the high-end manufacturing, right? You don't want to cut some costs here, go to another country, and then end up, your chips or something goes wrong, and you lose a lot of money, right? So for this, especially for high-end, the high value in the chain, right? I think Singapore is still really the location to choose.
Yeah, I agree with Sian Yang. And this is, I have direct experience because I speak to MNCs, the tenants that I have. I know people always say that there's a Singapore premium, right? Actually, I share with you that after the pandemic, this Singapore premium has also another connotation, and that is the Singapore insurance. Because during pandemic, when the whole world closes, everyone close their borders, Singapore is still open for business. During the pandemic, every office REIT will tell you that they all work from home. Our guys, our tenants are still performing. Our guys, tenants are still manufacturing, still doing. So industrialists has tell us that actually, yes, we know your labor cost is going up, occupancy cost here is expensive, blah, blah, blah. But they're telling that in a down cycle, the fact that factories are not open, we cannot export out our goods, we cannot import out our raw materials of manufacturing. It costs us more than the occupancy cost that we have. So it's the fact that Singapore is still open for business, and the government is talking to industrialists and come out with rules and policies to help them. I think they take that extra so-called premium as an insurance that things still works on that. And we have a lot of experiences, examples of that. Many years ago, people will still remember this thing called PTP, Port of Tanjung Pelapas, supposed to be the biggest thing since, the biggest things, and it's touted to compete against Singapore. We even lost people who can remember would see that we even lost Maersk. After 1 year, Maersk came back. And now, I think, I'm not too sure what is the status with PTP, the plan may be still there, and we are doing a Tuas megaport. So, yeah, I mean, look, I'm not. I think the government, for us, and our policies as a whole, gives us that brand premium. Thing works, and because we are a logistics hub, we are a trade hub, things needs to work. Your seaport, your airport has to work. The day your seaport and airport does not work, I think we're not relevant anymore. And that is very strong. That's the reason why it's very strong for us for logistics. As Sian Yang mentioned, logistics guys at DHL, FedEx, whoever you are, they are here. But the value of the goods that they are transporting, that they are dealing with, are higher. Who the hell would actually imagine one day that car will be manufactured in Singapore? But Hyundai electric cars is done out of Jurong. Because the value is high, things work. Because to put electric car together is not Lego. You have a lot of things that needs to come in. And if your port, your seaport, your airport schedules are not there, nobody is operating it, it's not efficient, you have a big problem. Raw materials that miss a flight to come in, you got to stop manufacturing. It's very clear. We don't manufacture things here from start to finish. It's all parts coming in, assemble, boom, out. And if your airport, your seaports are not working, you will not be relevant. Yeah. So I see that as industrialists has been telling us because of the pandemic, whether you call it strengthen the Singapore premium or they call it insurance, I see these guys more as insurance than anything else.
Okay, thanks. So that's a seg to the last question, which is Singapore property market. I think residential property market has held up very well. Our prices are at a record high in the residential sector. Property prices in the rest of the world are trending down. How long more can we defy gravity? Well, we've got to ask Sian Yang that, because I also want to know, we're all interested in the Singapore residential market. Outlook.
Yeah. Okay. So maybe just to end off, I think, yeah, indeed, I think there's been an uptrend, and it's also defying gravity. And the mean reversionists will always think, well, it has to come down sooner or later. But I think there are a few factors, right, to consider. Right. Number one, construction costs is still high. Right. It has gone up by what agent said, I think 30-40%. Right. And usually, unless there's a financial crisis, it doesn't come down. Usually, I mean. Yeah. So, in terms of replacement costs, right, to build another property, that is still high, right. Number two, you talk about new launches, right, for a developer, right. No doubt it is slowing, right. It's definitely not as fast as last year, where developer launched 60-70% all sold out. Now it's coming about 30% or so, which is actually somewhat similar to what it was before the pandemic, right. Actually, even before, there were some years it was even worse, I would say. So developers, they are not in. I mean, they had a very good year, right? And their unsold inventories are also really still at record low. It is coming up, but it's still low. I think it's about 15, 16, 17,000 units. In the past, it was over 20,000. So there's no, I would say, motivation for developers to really meaningfully cut prices, especially when development risk is high. And finally, the last one is, for everyone that owns a property, right? Unless you lose your job, you'll never sell your property. You will never sell. So that what causes prices to really come down is when crisis, people start losing jobs. They have no choice but to sell or downgrade. Right now, with unemployment at 2% or so, I don't see that stress in the market. That stress hasn't come in yet. Right? I really just watch mainly the unemployment. Right? We hear a lot about layoffs, right, in the market, but actually, a lot of the layoffs, especially in the tech sector, they get hired pretty quickly. Yeah. So with all these factors, these will support prices. I'm not saying that you will see another huge growth in prices. I think that has really come down, but it will be more of a sideways trend, especially when we are seeing more supply into the market this year. But we look at next year and the year after, supply is actually coming down again. So I mean, speculatively, 2025 could be another year to watch out for.
Okay, so I think that's all we have, but there's one question I'm dying to ask. What about all these ultra-luxurious, ultra high-end properties that are coming into the market following, this $1 billion issue with the guy jumping from Ewart Park?
That will at least be 12 months' time, isn't it?
Yeah. I mean, there's all this news, but they are all under, I think, court proceedings. Which
so that we can't get our hands on. I mean, people who have a.
Yeah, it may come in the auction market maybe months later, and also I would say it's a small segment of the market. Right, most of the sales now is really in the mass market, in the outside, in the city fringe.
My 2 cents worth of this is that the Singapore residential market and the prices suffer from this thing called winner's curse. Because Singapore is safe. That is why, and things work. Jobs market is efficient, is there. So we are suffering from a winner's curse. Do we want to be always be the winner and get this curse, or do you want to be a loser and end up property prices collapse? I think my choice is probably to be a winner's curse.
Okay, so on that note, thank you very much for staying on. For those of you who've stayed on,
Thank you very much.
Thank you.